going to cover on the accounting concepts, the accounting principles. Then we'll also cover on the accounting equation, which now will be introducing us to start the computation for the company account. So I welcome you all to this class and make sure that you be attentive, because this is a very examinable question in the past paper. When you check on the last sitting, it was a question that was there. And when you also check on the other sittings, majorly on November sittings, you'll also find that this question for company accounts was there. So I want you to be attentive in this class, and I want to assure you, if you go with me, I will make sure that this paper, I make it easy for you, and I will make sure that you're going to pass the paper. So I encourage you to follow what I'm doing, and I will as well give you time to ask questions if you may be having any question. If you may be having any question, I will tell you to come. I will give you your own time to ask that question, and I assure you all will be well, and will be able to undertake all those. You will be able to undertake the question for the company account very easily. So for today's class on the company account, I will do some questions, which after doing the questions, I will also be able to give you some assignments that will be required to do. And then after doing the assignments, you are as well required to remit those assignments for marking. The financial accounting paper is a question of is a paper for 5 questions, which always takes one question for the theory and the rest is for computation. And I majorly you do find that students do waste time when they are computing the financial statements, because they will take maybe in one question they can take more than 1 hour. And instead for the students to take more than an hour, I will also be able to show you how you can make as well easier for you not to waste time in computing the financial statements. So as I start, I want to introduce majorly on the financial accounting. I want to just majorly introduce what is accounting before we get to those other the accounting principles. Then we get to the company account. So for when we talk of accounting, it is an art of recording, classifying, and summarizing transactions that are of financial nature, and therefore thereof interpreting the results. So when basically we're talking accounting, in this case you are recording, you have to give also a summary. You have also to classify, and basically when I'm talking about classification, I'm talking about classifying the assets, classifying what is liabilities, and etc. So when we talk of the accounting, there are some of the qualitative characteristics of financial or of a good accounting information. And some of these qualitative characteristics we have, number one, we have, for example, like understandability, whereby the information that you give into the users of financial statement should be well understood. We'll also be able to talk about the other qualitative characteristics like relevance. Also, we'll talk of reliability and etc. This one I'm going to give out the notes for you to read on your own. We also have in financial accounting again, we also have the accounting standards, which also I'm going to give out I'm going to give the notes for you to read on yourself. When we talk of accounting standards, what we'll be using when we'll be preparing the financial statements. So in this case, we'll use the accounting standards which we must follow for us to prepare the financial statements. So again, we'll also be able to talk about the accounting principles, which are now the assumptions that will enable us to prepare the financial statements. Because when you are preparing the financial statement, majorly you do follow those accounting principles. Like for example, we have the going concern accounting concept, which states that an entity is required to prepare financial statement that are foreseeable for the future. Meaning that when you are preparing the financial statement, they can as well be foreseeable in future. We'll also be able to measure on the accounting, the accrual concept. When we talk of accrual concepts, is a concept that says that all the revenues stroke the incomes and the cost, all the expenses should only be recognized when incurred. Or else when we talk of incomes, you only recognize them when you earn them. So again, you also note that in the case of the expenses, you are only supposed to recognize it when you have incurred that expense. So meaning that if you do a transaction, maybe like for example, you are supposed to pay some expenses like rent, and then before the year ends, you find that you have not paid the whole amount of rent. In this case, what you are supposed to record is the whole amount or the whole value of the rent expense that was incurred in that whole year. So in that case, the other amount that you have not paid, we will take it as an accrual, and therefore you take it on the current liabilities because already is amount that you have been owed. We'll also have to look on another concept known as the matching concept. When we talk of matching concept, this is a concept that explains, it says that all the revenues should be matched with the expenses that were incurred in the course of that year. And basically, in that case, knowing some of those accounting concepts, it will enable us to get through the financial statements of a given entities. Like for example, I've said in this case, I've talked about the accounting concepts, and the accounting concepts that I've specifically stated here, the accounting concepts that I've specifically stated, we have number one, the going concern concept. The going concern concept. So when we talk of the going concern concept, in this case, going concern concept states that all the transaction or the company should prepare the financial statement that will be predictable or can be used for a foreseeable future. Meaning that if you see this company, it can as well survive for the coming years. The other major concept that we'll as well use in preparing the accounting, the financial statements, we have the accrual concept. Whereby I've said, in this case, when we talk of the accrual concept, it states that the revenues and expenses should be recognized when earned, and in the case of the expenses should be recognized when incurred, and not necessarily when cash is paid or received. So we'll also be able to talk about the matching concept, which is as well applicable in preparation of the financial statement, whereby when we talk of matching concepts, it states that the financial statements, or like for example, when we talk of the revenue, remember in this case we have to use the revenues and the expenses. It states that when we talk of the revenues should be recognized, not recognized, but basically revenue should be matched with the expenses that were incurred in a given period. So basically what we mean in this case, all the expenses or the income that were incurred in that year should be recognized in that year. So when you find a company having paid some expenses for the next year, that is the payment in advance. When a company pays some amount in advance, in that case, it means that it is for the next period. And therefore, in that case, the amount for the next period is supposed to be recorded in the financial statement of the next period. It is not on the current year. And therefore, for the prepayment, basically on the expenses, we are supposed to less. And therefore, that's why, again, we check the prepayments on the current what? On the current assets. So those are basically the accounting concepts that majorly they may be required in preparation of financial statement. Another one, we have also the duality concept. We have also the duality concept. Now, when we talk of duality concept, this states that every transaction must have two effects on the account. Every transaction must have two effects on the account. And in this case, you take us to the double entry. That is the double entry bookkeeping, whereby if you have to debit a given transaction in a particular account, you as well record it or credit it on another account, and therefore in that case it will bring us to what we call the double entry what? The double entry system. So basically those are the major accounting concepts that maybe we'll be using when we be preparing the financial statements. Now, another part that we'll also have to cover to enable you to understand what I'm talking about is on the accounting equations. The accounting equation. Now, when we talk of accounting equation, it says that the assets should always be equals to the capital plus the liabilities. Should always be equal to the capital plus the liabilities. So what we mean in this case when we talk of assets, these are now the economic resources that are of future reference to the company, meaning that in this case their benefit will be recognized in that company for now and even in future. Like for example, when we talk of assets, in this case they are in two categories, whereby we have in the non-current assets, we as well have the current what? The current assets. Now the non-current assets are those assets that can be used for more than one accounting period. That is, they can be used in 2 to 3 years and more. Now we also have the current assets. Those are the assets that keep on changing. Like for example, we have the stock, we have the trade receivables. When I talk of keep on changing, when you buy stock today, tomorrow you may find it is not the same amount that you have in stock, meaning that they are changing every time. Now, we have also what we call in the capital. Now, for you to start a business, what you need to have is the capital to start that business. And therefore, for you to start the capital that you input in order to start that business is basically what we are calling the capital. We'll also be able to know about the liabilities. Now, liabilities are the amounts that you may borrow in order to finance all these assets that you are having. They have said they are like obligations, future obligation that maybe you have borrowed this amount in order to finance the assets that you are having. So in this case, there are other items that you need to know when we talk of liabilities. Now, liabilities are again in two categories. We have the non-current liabilities and we have the current liabilities. Now, the non-current liabilities are those liabilities that can be, they are future obligation that is happening for more than what? One accounting year. Like for example, we have the loans. when you borrow the loans, maybe you're not supposed to pay in that accounting year. You may borrow the loan and pay it in future. That is in 3 years to come, 4 years, and so forth. So again, we have the current liabilities. They are those liabilities that are supposed to be paid in the course of that accounting year. Like, for example, we have what? We have the trade payables. That is the creditors. When you purchase some goods as the company, you need to pay for those creditors maybe in the course of that year. And basically, that is what you need to know when we are talking about the accounting equation. Now, in this case, accounting equation will be useful when we will be preparing the statement of financial position. Long time ago, that's what we used to call the balance sheet. So in that case, we have to prepare the financial statement and look whether the assets are equal to the capital plus the liabilities. So majorly what you need to know on the introduction part is what I've talked about. That is on the accounting concept. I've also talked about the accounting equation, and also I've also elaborated more on the accounting standards. So for now, I want to begin with a basic topic that we was to start today, which is on the company account, which is on the company account, which is on the company account. That is what I want to start today. I want to start today on the company account, and we know more what we are required to prepare on the company account, what we are required to prepare to know on the company account, what we require to know on the company account, on the company account. Now, when we talk of a company, this is a voluntary combination of individuals who come together to do a business. Now, in this case, we have two types of companies. We have the public companies, and we as well have the private companies. Now, when we talk of public companies, these are companies that have to issue shares to the public in order to raise capital. Now, we also have the private company. These are companies that are not required to issue or to subscribe, or the members of public are not required to subscribe to their shares. I mean, in this case, when we talk of public, or when we talk of private companies, the members of public cannot subscribe to their shares. That is on the private companies. Now, what we need to know in this case is about the shares of a company. The shares of a company. Now, when we talk of the shares of the company, in this case, these are now the owner's interests. For these individuals who come together, they have to buy the shares, the owner's interest, which in this case, the owner's interest is in form of, the owner's interest is in form of shares. The owner's interest is in form of shares, And therefore, when we talk of shares here, they are also as well divided into two. We have the types of shares, which are as well divided into two. Number one, we have the preference shares. Number two, we have the ordinary shares. Number one, I've said we have the preference shares. And then number two, we have the ordinary shares. Now, when we talk of the preference shares, these are shares that earn a fixed rate of dividend. I've said, I will repeat again, these are shares that earn a fixed rate of dividend. when you check on the financial statements, or basically on the financial statement given on the question paper, you will find on the free branch shares, they have started with a rate. That rate is what I'm talking about, the fixed rate. Now, free branch shareholders do not have any right to vote over their shares. They do not have any right to vote over their shares, and therefore they do not have any control over what? Over the company. They do not have any control over the company, and therefore that's why you find that the free branch shares are more favorable than the what? The ordinary shares. Now, let's just again talk about the ordinary shares. Now, when we talk of the ordinary shares, these are now what we call the common shares. Now, the reason that I'm talking of them being common shares, the members of the ordinary shareholders, they got a right to vote over their shares. They got a right to vote over their shares, and therefore, they again have the control over the what? The control over the company. And that's why I've said they are common, because they are known. Again, the members have the right to vote over their shares. Again, the members, they have control over the company. Now, again, we have also to know that when we talk of shares, they are they can be issued. Shares can be issued either. Shares can be issued either at value. They can be issued either at value. It can as well be issued at a premium. At a premium. They can as well be issued at a discount. At a discount. I will repeat again. Shares can either be issued at value, it can as well be issued at a premium, or can as well be issued at a discount. Now, when we talk of the shares being issued at fair value, is whereby they are being issued at their nominal value. When I talk of the value, in this case is also what we call in the base value. So in this case, you find that the shares have been issued at the nominal value. Now, again, we have the shares being issued at a premium. In this case, is whereby the shares have been issued at a price that is higher than the value. A price that is higher than the value. The price that is higher than this. If it is higher, is higher than value, in that case, if it is higher than value, in that case it is the share premium. And therefore, the difference between the issue price and also the value is what we take to the share premium account. The difference between the value and the issue price is what we take to the share premium account. Now, the last one is at a discount, whereby the shares are being issued at a price that is lower than the value. However, in this case, this is not allowable in the stock exchange. You will only be allowed to issue that in this case when you are issuing, like for example, the rights issue. And when I talk of rights issue is when you are issuing the ordinary shares to the existing shareholders at a price that is slightly below the value or the issue price. In this case, I've said you are issuing to the existing shareholders. So that is majorly what you need to understand on that part of the types of shares and the how the shares of the company are issued. Now again, we also required to know, you are also required to understand, you are also required to understand, you are also required to understand, we also have the capital reserves. We also have the capital reserves. Now, the capital reserves are basically what is being generated out of for example, like the revenue reserves, for example, like the share premium and so forth. Now, these are those amounts that once they are received, they are supposed to be taken to the reserves. And the capital reserves that I'm talking about in this case, the capital reserves that I'm talking about in this case, we have number one, like for example, we have the share premium, which I've already talked about up there on the issue of shares. When I've said on the share premium is the amount or when the shares are being issued at high value, that is a value that is higher than the value. So in that case, what you need to do, you have to look for the difference between that value and the what? The issue price. What you get there is what you take to the what? Is what you take to the share premium account. We have also number two, on the part of the capital reserves, we also have what we call, the revaluation reserve. Revaluation reserves. Now, revaluation reserves, in this case, will occur majorly on the non-current assets. That is basically the land and buildings. When now you engage a revaluer and he values the land at either a value that is higher or lower, you take that, the difference, to the revaluation reserve. So basically, those are the part of the capital reserves that we need to be aware on that case. Now, well, let's now talk about the financial statements of a company. Let's now talk about the financial statements of a company. The financial statements of a company. Financial statements of a company. Financial statements of a company. Financial statement of a company. Now, in each and every accounting year, a company is required to prepare financial statement. I will repeat this again. In each and every year, a company is required to prepare the financial statement. Now, a complete set of financial statement comprises of the following. A complete set of financial statement comprises of the following. Number one, we have the income statement. Number one, we have the income statement. Number one, we have the income statement, which in this case, the income statement is just showing the financial performance of that company. Number two, we'll also have the statement of financial position. Statement of financial position. Statement of financial position. In this case, for the statement of financial position, will be showing the position of that company. Number three, we also have the statement of changes in equity. Statement of changes in equity. Now, in this case, when majorly I talk about the equity, we need to understand that equity are all those items like the ordinary shares, the share premium, and all other what? Other reserves. So basically you are preparing the financial statement to show the balances for all the equity items. Now again, we have also the statement of cash flows. We have again the statement of cash flows. Now on the statement of cash flows, in this case, we are just showing the cash movement, And then the last one is now the notes to the account, That is basically what comprises of a complete set of financial statement. Note to the accounts are those notes that you prepare, like for example, you base it on the additional information. Now, in this case, we'll be able to talk about the income statement to know how it is being prepared. And again, we'll also be able to talk about the statement of financial position. And then I will as well show you the statement of changes in equity and also the notes to the what? The notes to the accounts. So let's just begin with the income statement. And know how it is being prepared, the income statement, and how it is being prepared. In this case, I'm talking about the income statement format. So the income statement format. Now, in this case, when you are preparing the income statement, you have first to ensure that you begin with the name of the company. Now, in my case, I will choose XYZ Limited as the company, as the name of that company. Then in that case, you talk about the income statement. For the year ended, let's say 31st December, a year that we don't know in that case, a year that we are not aware in that case. So in this case, I will have these two columns, that is shillings in thousands and the shillings in thousands. So in that case, I will begin with the sales. That is majorly the revenue. I will take it there. Again, I will less the return inwards. I will less the return inwards there. What I will get here is the net sales, which after getting that value, I will take it to the far end. From there, we also have to less the cost of sales. And on the cost of sales, we'll begin with the opening stock. And on the opening stock, we will bring that value there. You add the purchases. Then you also as well add the carriage inwards. You take them there, the carriage inwards. You less the return outwards. And then the last part that you need to less is the closing stock. So what you get after this is now the cost of sales, which again, I will take it to this far end and less from the sales. So what I will get here, after taking the net sales, I minus the cost of sales is now what we call the gross profit. Now what we call the gross profit. That value, you will bring it there. Now in that case, you will add other incomes. You'll add other incomes. And the other incomes, let me just check on just one part of the other incomes, like for example, the discount received, the discount received, the discount received, which I'll bring it to this per end and add that. What we'll get here is the total income. What we'll get here is the total income. Now from there, you less expenses, you less expenses, you less expenses. And the expenses that we are having, for example, I can talk of the discount allowed. We'll talk of the discount allowed. I bring the amount here. We talk about the bad debts and all other expenses that you are aware that will be given on that income statement. Like for example, depreciation, we bring it there and we get the total expenses. After getting the total expenses, you will less from the total income, and therefore what you will get here is the profit before tax. Profit before tax. Profit before tax. So after getting that, what you'll be able to get from there, you are supposed to look for the corporate tax. Corporate tax. Corporate tax. The corporate tax will less it from there. And what you'll be able to get here is now the profit after tax. Profit after tax. And that's how you prepare the income statement. That's how you prepare the income statement. So now from there again, you can as well be asked to prepare the statement of changes in equity. You can as well ask to prepare the statement of changes in equity. And I've said, in this case, you only base on the equity items. In this case, you will only base on the equity items. And I've said the equity items comprises of what? Comprises of what? The equity items, I've said it comprises of the ordinary shares, the preference shares, not the preference shares, remember, I've said it is the ordinary shares, the share premium, and all other what? And all other reserves. And when I talk of all other reserves, in this case, I'm talking about the what? I'm talking about the revenue reserves, which is also the retained profit. I'm also as well talking about the general reserves and all the capital redemption reserves. So on the side of the statement of changes in equity, this is how you are required to do. 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 So in this case, I've said you are just considering the equity items. We're just considering the equity items. The equity item. Let me just pick 3 of the equity items and draw the statement of changes in equity. I'll just pick 3 of the equity items. Like for example, I will talk of the ordinary share capital. Ordinary share capital. I will as well talk about the share premium. I will as well talk about the revenue reserve. The revenue reserve. The revenue reserve. So in that case, what we'll begin with here is the balance brought down. You put those amounts there, and you as well look for the total here. Don't forget to get on the total. Now again, you will also require to, if there is something somewhere where the company issued share, that is the issue of shares, the issue of shares will also affect either the ordinary shares and what? The share premium. So again, you will also as well look for the total. Now, we'll also have the profit after tax. The profit after tax. Remember the profit after tax, it is increasing the what? The retained profits. Retained profits are also the revenue what? Revenue reserves. So you as well add it from there. Again, you will also find that the company has paid dividends. Like for example, the preference dividend, which I've said is a fixed amount or is a fixed rate of dividend that is supposed to be paid. So if the company pays preference dividend, you will as well take it, because once you pay dividend out of the profits, so it means that it is reducing the reserve or the revenue reserve that you are having. The same case to the ordinary dividend. The ordinary dividend, they are as well reducing the revenue reserve. They are as well reducing the revenue reserve. Again, the company may as well in that case, the company may as well transfer some amount. For example, they can take the amount to the general reserve, of which in this case I'm not having the general reserve account. I will show you in the question that we are about to do right now. So after that, what you will get here, you will now come and get the balances carried down. What you will now take to the statement of financial position, And those are the balances that you need to know to take to the statement of financial position. Now, let's just try a question. For us to understand what I'm trying to explain here. So I want to do a question in the sitting of November 2018. I want to do a question in the sitting of November 2018, question number 4. November 2018, question number 4. I want we go together in that question of November 2018, question number 4. I want we go together in November 2018, question number 4. November 2018, question number 4. Now, the question is stating this. I'm reading from the CPA paper. That is the question of November 2018. I can see someone who is asking a question. I can also get someone who is asking a question. I'm going to send the complete format to you. The complete format, I'm going to send it to you, and you will as well understand as I'm doing this question that I'm about to do here. That is in this sitting of November 2018, question number 4. So just go with me, you will be able to understand the format even as I'm doing the question. Now, when you read on that question of November 2018, question number 4, Zamzam Limited has an ordinary share capital of 100 million shares of 1 shillings each, and 20,000 of 8% preference shares of 1 shillings each. Now, what we've been given there is what we call the authorized share capital. What the company is, the maximum amount of share that the company, or the amount of share capital that the company is required to issue. Now, the other one there, the following is the trial balance that was extracted as at 31st December 2017, as at 31st December 2017. Now, we have ordinary share capital issued at shillings 0.5 paid per share. That is 0.5 is the VAR value. We have also 8% preference shares, preference share capital, which is issued and fully paid. We also have the plant and machinery at cost. Let's go to the other side. Let's go to the other side. Motor vehicles at a cost. Motor vehicles at cost. We have the computer hardware at cost. We have also the account receivables and account payables, the corporate tax payable. We have the bank balance, 10% debentures, inventories, general expenses, purchases and sales, preliminary expenses, debenture interest paid, investment income, salaries. We have the salaries. We also have the insurance premiums, investments, that is shares in Guru, and we have the accumulated depreciation, that is for the plant and machinery, for the motor vehicles and the computer hardware. We also have the director's fees, we have the auditor's fees, computer software, interim preference, dividend paid, retained earnings, allowance for doubtful debts, and additional information. Inventories as at that 1st December 2017 were valued at 28,247,000. Investments have a market value of shillings 15 million. Debenture interest is payable in 2 equal annual installments. We have insurance premium prepaid as at that 1st December 2017 amounted to 240. Depreciation is to be provided as follows. We have the plant and machinery at the rate of 10% per annum on cost. Motor vehicles at the rate of 20% per annum on reducing balance. Computer hardware at the rate of 25% per annum on cost. The allowance for doubtful debts is to be increased to 7.5 thousand. We have the corporate tax, which is 4.75 million. It is to be provided for with respect to the year ended 31st December 2017. The directors proposed to pay the remaining dividend due to the preference shareholders at a first and final dividend to the ordinary shareholders at the rate of 6%. A sum of 2 million is to be transferred to the general reserve. So you are required to, number A, income statement for the year ended 31st December 2017. B, the statement of changes in equity for the year ended 31st December. And then we have the statement of financial position as at 31st December 2017. As at the 31st December 2017. Now let's just begin from the notes. Let's just begin from the notes. And I will begin with note number 1. Now when you read on the note number 1, we've been told that inventories as at 31st December 2017 were valued at 28,247. At 28,247. That is as at the end of that year, and that is our closing inventory. So our closing inventory in our case will be, let me just use the shillings in thousand, will be 28 247. Now, additional information number 2 again, when you check there, the additional information number 2 again, we have investments have a market value of shillings 15 million. Investment have a market value of 15 million. So let's just check on the investment. Let's just check on investment. Now, when you check there, we have the value that we've been given on the trial balance for the investment. The value that we've been given on the trial balance for the investment, this value here, the value for the investment, which we've been given 13,500. And again, we've been told that this amount, the investments have a market value of 15 million. So what will require us to look here is what we call either the fair value gain. What you require to look here is either the fair value gain or the fair value loss. Now, in our case, when you check here, what we are having on the trial balance, we've seen that it is 13,500. And on the additional information, it is coming to 15,000, meaning that in this case, it is a what? Fair value gain. So it is a fair value gain of what amount? You take 15,000, you less that 13,500, which in this case is giving us 1,500, which in our case is giving us 1,500. Now in this case, for the fair value gain, listen, for the fair value gain, we'll take it to the income statement. That is the income statement. We'll take it in the income statement as part of other what? Income, as part of other incomes. Now, we again go to additional information number 3. Additional information number 3. Additional information number 3. We've been told that additional information number 3. Additional information number 3. Additional information number 3. Now, when you check there, the debenture interest is payable in 2 equal installments. So what we'll do in this case, you will look for the total debenture interest for the whole year. The total debenture interest for the whole year. Now, what will be the total debenture interest for the whole year? Now, you will get back to the trial balance. And you will see somewhere where we've been given 10% debentures. The 10% debentures, which is at a value of what? 9,000. So in that case, what we'll do, the rate already being given, the rate of interest is 10%. So you'll take 10% of that total amount, which is 9,000, and in our case, you will get what? 900. In our case, you will get 900. In our case, you will get 900. So after you've done that, when you check again on the trial balance, we have been given the debenture interest paid, the debenture interest that was paid. So in this case, there is this amount that is already paid of 450. Are we together? Now in this case, it will take us back to the accrual concept. This company is supposed to pay 900 shillings for the whole year. But what they have paid, as we've seen on the trial balance, is only 450, meaning that there is amount that is not paid. And in that case, that is what we term it as what? Accrued, which is also 450. So in this case, for the income statement as an expense, you will take these all 900. But now on the current liabilities, because this company has not paid these 450, you will take big debenture interest as an accrual. So again, Again, we have number 4, which is insurance premiums. Insurance premiums. Insurance premiums. In this case, the insurance premiums were prepaid, meaning that the amount that was paid was for the next what? The next period. So in this case, I've said on the under the matching concept, the transactions that is for the revenues and the expenses should be matched that incurred on the same what? Accounting period. So in this case, this 240 was paid for the next period. So in our case, we'll just eliminate that amount because it was not incurred in this accounting period. So the amount that we are having as insurance premium on the trial balance is 750. So I will take 750 and less this other amount that was, this is the amount that was paid on the trial balance. I will less the prepaid amount. I will less the prepaid amount, which is of 240. So when I take my calculator, I will get this amount as how much? Take 750 minus that, which I'm getting 510, which in this case, this is now what we'll take as an expense to the income statement. Now, number 5 is on the depreciation. Is on the depreciation. Number 5 is on the depreciation. So when you check on the depreciation there, we've been given the first one. We've been given the first value. We've been given the first value on the first value that is on the plant and machinery at 10% per annum on cost. So in depreciation, we are having two methods of depreciation. In depreciation, we are having two methods of depreciation. And number 1, we have the straight line method. The straight line method. Now, the straight line method is whereby depreciation is provided on what? On cost. Depreciation is provided on cost. So in our case, in that case, we'll just take the 10%. I will multiply by the cost of motor vehicle, the cost of land and machinery, which will be given as 34,000, which is being given as 34,000, which in that case, I'm taking as 3,400, which I'm going to take it as an expense. Now, number 2, we have the reducing balance method. Reducing balance method, which is now on the second part of the motor vehicles, is at the rate of 20% per annum on reducing balance. Now, on the reducing balance is depreciation provided on the net book what? Value. So to get the net book value, in that case, I take the cost, you minus the what? The accumulated depreciation. Get the cost, you minus the accumulated depreciation. So in that case, I will take the 20%. I will multiply by the cost of the motor vehicles. In this case, remember this was the plant and machinery. I'm on the side of the motor vehicle. Now, for the motor vehicles, in that case, the cost that will be given here is 16,000. So I will take 16,000 minus, when you check again on the trial balance, we'll also see the accumulated depreciation, which is 7,200. And when I take my calculator, I take 16,000, I minus 7,200, and then I multiply by that rate, I'm getting 1,760 as the depreciation expense. So basically, those are the two methods in the that are used in when computing depreciation. Now, the third one is on the computer hardware. Computer hardware, which is again on cost. Computer hardware, which is again on cost. Therefore, we'll just take the rate, which is 25%, multiply by the cost of the computer, which is 5,000. And in my case, when I take the calculator, I compute, I get 25,000, I multiply by the 25%, I'm getting 1250, which again will as well take it as an expense to the income statement. For the depreciation, we'll again take it as an expense for the depreciation, of that computer hardware. Now let's get to the next additional information. That is additional information number 6. Additional information number 6, whereby allowance for doubtful debts are to be increased to how much? The allowance for doubtful debts are to be increased to 7,500. So on allowance for doubtful debts, in this case, you either look for the increase or decrease. We'll check for the increase or the decrease. Now, for the increase, you take it as an expense. In this case, for the decrease, you take it as a what? An income. Now, in our case, already we've been told that it was an increase, and therefore, we will just take the difference. The difference for you to know the increase, because in this case, we were told that it was increased to 7.5. Therefore, in my case, I will take 7,500. I will minus what we've been given on the trial balance, where it was increased from, which is 5,300. And in this case, when I take my calc, the amount that I'm getting there is 2,200. So in this case, this is what you will take to the what? To the income statement. Then again, when we talk of doubtful debts, these are amounts that you are in doubt that this customer is going to pay. And it means that because when you are preparing the debtors account, you have already included these amounts. So these values where these amounts were increased to, you as well reduce on the trade receivable. You as well reduce it on the trade what? Receivable. You will as well reduce it on the trade receivables. Now the next one is on the corporate tax. That is number 7, on the corporate tax. Now, when you check on the corporate tax, we've been told that the amount that was payable in that year. So what we have in here, our income tax expense for this year, the income tax expense for the whole of that year is what we've been given as 47.50. This is what you will take to the income statement. That is basically the profit and loss. Now, when you check on the trial balance, there is the corporate tax payable. Now, when you check on this, we have the corporate tax payable. This corporate tax payable is for the previous year. So in that case, the corporate tax for the previous year, it means that it was not paid, and therefore still it is a liability to the what? To this company, the corporate tax. So we'll also add this corporate tax payable. Of shillings 1970 to know what we'll be able to take. To the income statement, to the statement of financial position. I can see someone who is asking about the debenture interest concept. In this case, I've said that you will take the rate of debenture. The rate of debenture that will be given on the trial balance, that is 10% debenture. So what you will get is the rate you multiply by the total debenture capital, which is 9,000. I've taken the 10%, I've multiplied by the 9,000. What I'm getting there was 900. Now, again, when you check on the trial balance, whatever is on the trial balance is what the company has already paid. Now, in our case, the company has already paid 450, meaning that there is extra amount of 450 that the company has not paid. And therefore, that's where we have applied the accrual concept. That's where we have applied the accrual concept, whereby the transaction must be recognized when incurred. Therefore, we were supposed to recognize it on the income statement. So let's just complete on the corporate tax, whereby I've said we have the one that was not paid for the previous period, and I'm adding it here to get the total value, which is 6720. So this is what we'll be able to take to the company current liability as our corporate tax payable, as our corporate tax payable. Now, the number 8, we have the ordinary shares there, the ordinary dividend and the preference dividend. We have been told that the directors propose to pay the remaining dividend due to the preference shareholders. So let's just begin with the preference dividend. Let's begin with the preference dividend. Let's begin with the preference dividend. Now, in our case, when you take on the preference dividend, on the trial balance, we've been given the rate as a rate of 8%. We've been given the rate as a rate of 8%. Therefore, in that case, you will take the 8% out of the total preference share capital, which is 8,000, And therefore, what we've been getting here is an amount of, if I take my calculator, 8,000, I multiply by 8%, I'm getting 640. I'm getting 640. This is the whole preference dividend. So I want again you listen to here. We've been given there on the trial balance, the third last part, we've been told that the interim preference dividend paid was 320. So meaning that here we have the interim that was paid of 320. Meaning that still, again, as we apply the accrual concept, there is the final which was now proposed to be paid of 320 that was not paid. So in this case, again, you will take this final as the current liability. I'll repeat again. I've taken the 8% to know the old preference dividend that this company is supposed to pay. So in that case, I've gotten 640. So we've been told that on the trial balance interim, he paid 320. So the final is what is remaining for us to get 640, which is 320. And I've said this value, you as well take it as a what? Accrual on the current liabilities. Now, again, we have also the ordinary dividends. We have also the ordinary dividends. Now, in our case, we've been told that the ordinary dividends will be paid at a rate of what? 6%. So we just take the 6% and we will go to the ordinary share capital, where we've been given the whole value of 50,000. So what we get in there, this is now the 3,000, which is now the ordinary dividend that was proposed to be paid. That was proposed to be paid. And then the last one is now the general reserve. So on the general reserve, what was transferred was an amount of what? 2 million. So that is how you prepare the notes. But at the end of it, you will find that you can waste a lot of time in preparing these notes. And instead of wasting time in this case, in my next question, I will show you how you can as well do the question without following or doing all these notes. We just begin direct with the question. So now, let's just now prepare the income statement very fast. Let's now prepare the income statement very fast. Let's now prepare the income statement very fast, and also the statement of changes in equity, and then the statement of financial position, the statement of financial position, the statement of financial position. So now I will begin here. I will begin here. I've said this was November 2018 question. It was November 2018 question number 4. So in this case, I've said you begin with the name of the company, which in our case is Zamzam Limited, which in our case is Zamzam Limited. So I have the income statement for the year ended, that is on 31st December 2017. The year ended on that 1st December 2017. That 1st December 2017. So in my case, I will have shillings in thousands there, and also shillings in thousands there. So I will begin with the sales. I will begin with the sales. When you check on the trial balance, we've been given the sales there as an amount of 233,384. That is the sales. So from there, you less return inwards, but in our case, we don't have the return inwards. We don't have the return inwards. So if there was return inwards, you could have less that amount to get the total amount there, the net sales. You get the net sales. So you get the net sales. So from there, I will less the cost of sales. Which we have the opening stock, and our opening stock is 25,200. We add the purchases. When I check on the trial balance, our purchases is 164,764. In our case, we don't have the carriage inwards. I've already sent you the format. You will as well see that. I've already sent you the format. So I just skip some of the items that are not here. So I will less the closing stock. So our amount for the closing stock is 28,247. So in that case, when I take my calculator, what I'm getting as the cost of sales here is 161,717. So when I take the net sales, I less the cost of sales, what I will get here is the gross profit. So what is our gross profit? Will be 71 from my calculator, 71,667. So from there, I add other incomes. So in this case, we have number one, the investment income. Now remember, I've seen someone who was asking about the investment income. Now in this case, there is investment income, and then there is what we call the fair value gain or loss. Now in this case, the fair value gain on investment, I've said, is on the market value. So it was not an income. Therefore, we'll just take the investment income alone, which is 1125. Now again, we'll also have that the value gain, the one we got from the additional information number 2, That is the fair value gain, which was an amount of 1,500. And from there, you can get the total what? Total incomes. Can get the total incomes, which after taking my calculator is 17,292. So those are the total incomes. So from there, you less expenses. From there, you less expenses. Now, I will begin with the one that we did on the additional information. Number one was on the debenture what? Debenture interest. The debenture interest, which was a value of 900. Remember, on the debenture interest, what has just been paid is 450, meaning that the rest of the other amount, the 450, will take it as an accrual on the current liabilities. We have also insurance premiums, as we've also done on the additional information. Number 4, we've also found that it is giving us 510. Then we'll also have the depreciation. And the depreciation, I begin with the plant and machinery. The plant and machinery is 3,400 as we've computed. The other one was on the motor vehicle. The motor vehicle, we've also gotten 1760. And the last one is on the computer what? Computer hardware. Computer hardware. So on our computer hardware, we've gotten 1250. 1250. Now the other one was on the additional information number 6, whereby we found it is an increase in allowance for what? Allowance for doubtful debts. Allowance for doubtful debts. Allowance for doubtful debts, which was an increase of an amount of 2,200 from our notes. Then again, we also have the general expense on the trial balance. The general expense on the trial balance, which is giving us a value of 11,020 on the trial balance. We have also other expenses like salaries on the trial balance again, which are been given as 24,210. We have also preliminary expenses, which is also a value that is given there as 2,400. And then we have the director's fee, which is 7,000. And the last one is auditor's fee. And auditor's fee is 2,500. So if I get my calculator, I get the total expenses. 900, 510, 400, 1760, 1250. I also get 2,200. I also get that. What I'm getting here is a total of 57,150. 57,150. So I will take this income, I less these total expenses, and by that I will get the profit before tax. Profit before tax, which is an amount of profit before tax, which is an amount of 17,142. So from there, I will less the tax, corporate tax for that year. Corporate tax, the one that we've been given, I've said is the income tax expense of 47,50. And what we'll be able to get from here is the profit after tax. And that's how the value that I'm getting on the profit after tax is 12,392. That's how you prepare the income statement. Now let's quickly also do on the statement of changes in equity. whereby I have said in this case, you only consider the equity items. You only consider the equity items. You only consider the equity items. So in my case again, I will start with Zamzam Limited. There is the statement of changes in equity. Statement of changes in equity. Statement of changes in equity. This is for the year ended 31st December 2017. 31st December 2017. So the equity items that I'm having here, we are having 4 of them. We have the ordinary shares, we have the preference, the share premium, and as well we have the general reserve. So I will have the part for the ordinary shares, as well as for the share premium, as well as for the general reserve, and the last is on the revenue reserve. Then you get on the total what? The totals. That is, this is total. This is the retained earnings. This is the general reserve. And this is on the share premium. And this is on the ordinary share capital. So remember, always shillings are in thousands. It is good, or is also important to indicate them here. Shillings in thousand, shillings in thousand, and a shillings in thousand. So in that case, what we begin with is the balance brought down. Balance brought down is what ends on the trial balance. So in the case of the ordinary shares, I can see we've been given 50,000. On the share premium, we don't have. We also have the general reserve. We don't have any balance. Retained earnings, we have 8470. So 8470. And in this case, we have, this is on the total. When I take on my calculator, I'm getting 58,470. So from there, we'll add the profit after tax. And when you take on what we've gotten as our profit after tax, it was a value of what? A value of 12,392, which is increasing our retained earnings. So we will add it as well there, 12,392. And then also again, we'll also have the transfer to general reserve. Transfer to general reserve. So the transfer to general reserve, we have an amount of how much? Transfer to general reserve is an amount of 2,000. So that amount will be removed from the revenue, that is the reserves. You take it to general reserve. I repeat, remove it to the retained earnings, which is also the revenue reserves. You take it to the general reserve. So at the end of it, that will be 0. So again, we also have the preference dividend. Remember, dividends are paid out of the earnings. The dividends are paid out of the earnings. So the total preference dividend that we got here, 640, will be paid out of these profits or the retained earnings. The same case to the ordinary dividends. The ordinary dividend that we've gotten, the whole of that amount will also be paid out of the what? The retained earnings. And therefore, in this case, here we'll have 640 less than 3,000. So after that, we don't have any other item that is affecting the statement of changes in equity. And therefore, from there, I can get the balances carried down. From there, I can have the balances carried down.
So balances carried down. In the case of the ordinary shares, there was no issue of shares, so it's 50,000. Share premium, we don't have that amount. This is 2,000. This one, after I've done with my calculator, I'm getting 15,222. And then for this, the last one, the total, 67,222. So that is how you prepare the statement of changes in equity. That is how you prepare the statement of changes in equity. And the last, we can now prepare the last part, which is now the statement of financial position, which is now the statement of financial position. So we can as well prepare that one first. We can as well prepare that one very fast, the statement of financial position, the statement of financial position, the statement of financial position, very fast, statement of financial position. So in that case, we have as well Zamzam Limited, restatement of financial position. That is now the last part, statement of financial position. And in this case is as at 31st December 2017. 31st December 2017. So I will have shillings in thousand, shillings in thousand, shillings in thousand, and then shillings in thousands. So in this case, I will begin with the assets. And I remember, as I was talking about the accounting equation, I said that assets are divided into two categories. We have the non-current assets. Non-current assets. Now, non-current assets, you're supposed to record them at their net book value. That is the cost you minus the what? Or the total accumulated what? Depreciation. So in my case here, I will begin with the plant and machinery. Plant and machinery. Plant and machinery. I begin with the plant and machinery. So on the plant and machinery, the total cost was 34,000. Now, when you take also on the trial balance, we have in the accumulated depreciation, which we have been given as what? 16,000. And then there was the depreciation charge for the year that we computed, which was 3,400. So 3,400. So when I take my calculator, the net book value here, I'm getting as 14 what? 600. So again, we'll also have the motor vehicle. Now on the motor vehicle, we've been given the cost as 16,000. I will less the accumulated depreciation on the trial balance, which is 7,200. And after doing the depreciation charge for the year, I got 1,760, which in this case, I'm getting 7040. Now the other one is the computer hardware. I will do the same. I will take again the cost, which was 5,000. I less the amount, the accumulated depreciation, which is 1,750, and depreciation charge for the year, we got 1,250. So the value that I'm getting from here is 2,000. So I will also add the current assets. Now, current assets, we have the inventory. In this case, now you will talk of the closing stock. And our closing stock was a value of, 28,347. 28,247. So we'll also have the accounts receivables, which is also what we call the debtors or the trade receivables. Now I want you to listen here. Now on account receivables, the value that we have in on the trial balance, is an amount of 34,980. Now, when I was computing the allowance for doubtful debts, I've said the amount where it was increased to, it means that this company is in doubt that this amount will be paid of 7,500. So in that case, we will less that 7,500. And when I take my calculator, I'm getting 27,480. Then the last one is the next one is the bank balance. There is a value that I've forgotten here. We have also the investment. Investments are also part of the current investments. Let me just have it here. Investments are also non-current assets. So investment, that value of where the market value now of 15,000, you are supposed to as well take that value to the non-current assets. I will repeat, investments are also non-current assets. Therefore, the value you take it to the non-current assets. Now we have also the bank balance, which on the trial balance is 14,505. The next one, we've been given computer software, which is a program. So for the computer software, this is also a current asset, and the value that will be given on the trial balance is 1,500. And the last one, I said prepaid insurance, it was paid for the next period, and therefore if you can as well need for that cash, you can be refunded the money. Therefore, that why we are taking it as part of the current assets. So after that, what you will get here is the total assets. What you will get there is the total assets, which I will compute after I'm done with on the part of the equity and liability. So in this case, again, we get to the equity and liabilities. Equity and liabilities. So on the equity and liability, I begin with the capital and the reserves. Remember already we had prepared the statement of changes in equity. So part of those balances, you already have them. So I will begin with the ordinary share capital. And ordinary share capital, the amount that we have is 50,000. We also have the preference shares, which is also on the trial balance as 8,000. Again, we have also what we are having on the general reserve, and on the general reserve we have 2,000 on the statement of changes in equity, and again we have the revenue reserve, which after computation I got 15,222. Then from there, the revenue reserve, remember they are also the retained earnings. So the other part is now on the non-current liability, where we are having now the 10% debentures, which in this case, the 10% debentures, what we be having here is 9,000. And then the last part is on the current liabilities, And therefore, we have the trade payables, which on the trial balance, I'm having a value of 15,900. Again, we have the corporate tax that is now payable. Remember, in this case, is inclusive of the previous year, and we got 62,720. Then again, Remember, for the debenture interest, as I had explained, there is the debenture interest accrued. The debenture interest accrued. Remember, the company had already paid the 450, so meaning the rest of the 450 was not paid, so it's still a liability to the company. Remember also on the final dividend, proposed preference dividend, the final one was not paid. So again, we'll have that value here. Again, we'll have that value of 320. And then the last part is also for the proposed ordinary dividends, which is not paid, ordinary dividend, which is also not paid, of 3,000. And therefore, from there, you can now get the total equity and liabilities. Total equity and liabilities. Total equity and liabilities. And after getting my calculator, what I'm getting here is 110,612, as well as this other part, which is 112, 10,612, 110,612. So basically, that's how you prepare the statement of financial position. And remember, when you are preparing the financial statements of an entity, in FA, what is marked is the entries that you make. So make sure that even if some of the parts you are not aware, you make the entries where you know. You make the entries where you know. I don't know whether there is anyone who is having any question. Don't know where there is anyone who is having any question. Anyone who is having any question? Now, there are some of the notes I'm going to send for you in the group, the notes, and also part of the format. I'll send you in the group. I'll send you in the group for you to analyze it from there. For you to analyze it from there. Anybody with a question? Anybody who is having a question? Anybody? So I think you have understood on the concept of debenture. You've understood on the concept of debenture. So you have understood on the concept of debenture. I don't think whether there is anyone who is having a question. It's okay. So you will do November 2016 question 1 as an assignment. November 2016 question 1 as an assignment. That is what you do as an assignment. November 2016 question number 1 you do as an assignment. Now, when we when we talk of computer hardware, remember for this, we have the computer software. Software is a program. And when I was talking about the current assets, I said these are the assets that keep on changing. Like for example, I gave an example of inventory. Once you have it today, tomorrow you not have the same thing. That is the same case of the software. They keep on changing. That's why I've taken it to the part of the current assets. So make sure that you do that as assignment, and we meet on the next class. I will be doing manufacturing account. We meet on the next class. I will be doing manufacturing account. And remember, manufacturing account, when you check on the previous sittings, is a question for the May sitting. And in this case, for the manufacturing account, I simplify it. I will not do all those many computation on the notes. I will just do it direct. And I think you will just understand on that. Thank you for attending the class. Let's meet on next week on the same time.